Okay, so here we are, week of November 3rd, 2025. And, the market picture is, well, it's complicated. We just saw the S&P 500 hitting all-time highs. Pure momentum, looks fantastic on the surface. But dig a little deeper, and there's this kind of dark secret building underneath. Technical stress. We're talking specifically about the Hindenburg Omen today. It's a classic signal. Flags severe market breadth issues. And we got 2 confirmed triggers, October 17th, and then again just now, October 30th.
That's right, 2 triggers back to back.
Yeah, it feels significant. More than just, random noise. It screams concentration risk.
Exactly. So our mission today really is to do a deep dive. Let's unpack what this omen actually tells us about the market's health right now. And crucially, look at the big events this week, earnings, key data, because they could be the catalyst. They could decide if this is a fragile bubble built on a few stocks or if it's a genuine breakout.
Okay, let's break down the omen itself. What are the mechanics? It sounds dramatic. Well, it requires this weird contradiction, right? The S&P 500 has to be trending up specifically above its 50-day moving average. So strength.
Strength.
But at the same time, you need a significant chunk of stocks on the New York Stock Exchange hitting both 52-week highs and 52-week lows. We saw, over 2.8% doing that?
Yeah, the numbers were 476 highs and 170 lows on the trigger days. That's the split market signal.
And the final piece, the McClellan oscillator, which measures internal momentum, has to be negative. It just screams internal conflict.
It really does.
Now, okay, these kinds of scary-sounding signals pop up, and often nothing happens right. They don't always predict a crash. So why should you, the listener, really pay attention this time?
That's a fair question, because you're right. A standalone signal, its predictive power isn't amazing, maybe 20–25% chance of forecasting major decline. But the key here is the repeat triggers. Getting 2 confirmed signals so close together, that dramatically increases the odds. It acts like a much stronger warning flag.
Okay, so the repetition matters.
It really does. And also, keep in mind the timing. Historically, if there is real market damage from an omen signal, it typically shows up, say, 3 weeks to maybe 6 months after the trigger. So it's a forward-looking risk.
Right, not necessarily an immediate plunge tomorrow.
Exactly. And this whole scenario, it delivers a really critical insight for you right now. It highlights that a handful of mega-cap tech stocks are basically doing all the heavy lifting. The Nasdaq's up, 22% year-to-date? Phenomenal. But that's masking the fact that the median stock, maybe represented by the small-cap Russell 2000, is basically flat or even deteriorating.
So the generals are charging ahead, but the troops aren't following.
Precisely. You could call it artificial concentration. It's not the sign of a broad, healthy bull market. It's the kind of structural rot the Hindenburg Omen is designed to detect.
And that concentration, that potential fragility, it's going to face some immediate stress tests. Just this week, Monday, November 3rd, we get the ISM Manufacturing PMI. That's a huge health check on the industrial side of the economy.
Critical number.
And after the close Monday, Palantir, PLTR, reports earnings. Big tech-related name. Then Tuesday, we get Joltis job openings data, another look at the labor market, followed by AMD earnings after the bell.
So key data, key earnings. Let's talk technicals, too. Where's the battleground for the S&P 500?
Yep.
Okay, the absolute critical level to watch is 6,750. That's major support. It lines up nicely with the 20-day moving average, showing that short-term trend and the anchored VWAP.
The volume-weighted average price.
Yeah.
Where the big institutions have been buying.
Exactly. That's where the quote-unquote smart money has likely built positions. If 6,750 breaks, the door opens for a faster move down towards 6,600.
And the outside?
Upside resistance is sitting around 6,912. Getting through that puts the big psychological level, 7,000, firmly in sight.
Okay, let's pivot quickly. Equities are showing stress. What about crypto? Bitcoin often acts as a kind of risk barometer. Where does it fit in this narrative? Right now, Bitcoin's hovering around $110,071. It seems to be defending that $170K to $109K support zone.
Yeah, and that's important. When global risk appetite is strong, generally, crypto does well. Bitcoin holding that support is sort of constructive for risk assets overall. The major risk point for Bitcoin, though, is if it loses $106,000. A break below that level, that would signal a potentially broader loss of institutional confidence. It could cascade quickly down towards 98K.
So a break there could mirror the fear that the Hindenburg Omen is suggesting in equities?
It absolutely could. It reflects that same potential shift in risk appetite. But the most likely immediate catalyst this week is probably those earnings. Take Palantir. If they deliver a massive beat and significantly raise their future guidance, a real crush and raise, you could see a quick maybe 10% pop.
But maybe not sustainable.
Probably not. We'd anticipate folks selling into that strength given the broader context. But if Palantir comes out flat or guides cautiously, watch out. That could easily trigger a 15%, maybe even 20% washout in the stock.
Wow. And AMD.
AMD is crucial, specifically their guidance on the data center business. That's the litmus test right now for the entire semiconductor sector.
Which has been a huge part of that mega cap leadership.
Exactly. If AMD's data center outlook is strong, it could help prop up the semis and the broader market. If it disappoints, that could be the trigger that breaks support, not just for semis, but for the whole concentrated market structure.
Okay, so pulling it all together for you listening to this week, what's at the bottom line? It feels like the market faces a really fundamental, an immediate question. Is this a bull trap setting us up for a fall? Or is this a genuine breakout to new highs? Look, seasonality is often positive this time of year, so we remain sort of conditionally bullish short term. But that trapdoor below S&P 6,750, it looks pretty fragile. That mega cap momentum is definitely masking some underlying issues, that structural rot we talked about. And that 6,750 level feels like the line in the sand between a continued healthy breakout and potentially a much uglier systemic correction.
Which brings us right back to that core question the Hindenburg Omen is forcing us to ask. Are we actually seeing the early signs of a real, broad-based bull market taking hold, one with healthy breadth? Or are we just trapped inside a mega cap concentration bubble that's, well, about to implode? That's what you need to be watching this week. This weekly Market Navigator analysis is for educational and informational purposes only and should not be considered financial advice. Always conduct your own research before making any investment decisions. Paper trade ideas mentioned in this episode for your better learnings.